Welcome back, everybody, to another edition of Trend Following Trading Club Ideologues. Tough month, tough start to the new month. A lot of trends that I care about, that I'm in, are reversing a bit and have been for a while. So that's something we can talk about. Also, had some good discussions this week with Absolute about diversification and trend following diversification. And it looks like I need to work on my diversification some given recent performance. And anything else anyone wants to bring up, well, within reason, uh, about trend following or their trading in the markets. Good morning, Oleg.
Good morning, Jerry. Good morning, all the guys here. I'm very glad to see you all. I see Brian here, Alip, Jerry Smith, and other guys, and I'm really happy to see you all here. So, I'm of course really happy that I'm I'm a part of this conversation, wonderful conversation of trading ideologies, because I feel myself like trend following trading ideologies also. So I do a lot of things in my daily routine, maybe using trend following methodology. And so uh, my weeks, my days, my months, and years are always very nice, and I'm happy because I'm a trend follower. So every week is happy for me. It's one of my main principles, that in my trading, at least, every day is happy day, because I use trend following methodology, trend following ideology, trend following philosophy. So here it is.
Hello, Al.
Hello. Hey, Jerry. Hey, Oleg. Hey, guys. I mean, this week I was spending time to backtest the natural gas UK contract and the wheat UK contract. So the UK contracts are traded on ICE. I've never actually bothered adding them into my portfolio earlier on, just considering the fact that I've got a natural gas. Why bother at the one that is traded on ICE? But then I decided, all right, we've discussed on this forum so much that there are some benefits on adding even the UK natural gas contract. So I've added that, and I have added the feed wheat, which is the UK version of the wheat contract as well. And now I'm feeling guilty because there's cocoa. So there's a UK version of the cocoa as well, but I've never get a lot of pleasure in trading cocoa. So I'm not quite sure I'm going to add the UK version of the cocoa contract or not. But that's pretty much what I've been doing this week. I've been extending my backtests on 5-minute database. I even had a 1-minute database for all the contracts. So I guess 1-minute database has more than 1 billion data points, I would say. So I was just working on my backtest methodologies to be able to get back to trading on 1st of January. But that's what I've done this week. Thank you.
I want to say that I have heard a joke that it's not the best idea to trade something that is you can eat for breakfast, and so. But of course, if our capital is not limited, if we have this opportunity to trade as much markets as it's possible, of course, like Jerry teaches us that we must not take this history track record for the market, I mean performance of the market, very seriously. So if you have enough money to trade, I think there is no reason to not to trade cocoa if you not have, and if your capital is limited, maybe there are some reasons to look at such things.
You mean to say the UK cocoa, right? Because I'm already trading the US version of the cocoa. This is the UK version. This is UK version.
By the way, I have seen, I don't trade this US cocoa and UK cocoa, but I have seen this, of course, this market. But I think that I didn't, I don't know exactly, but I think it's.
So I trade cocoa, and I have traded it my entire career, and it's pretty much lost money every trade, or not every trade, but it's been a joke over the past few years that cocoa has been pretty bad. If you look at the chart, there's no trends. And then I've also been trading UK cocoa. So I've just done nothing except double my losses in cocoa. But now I'm long UK and short US cocoa. So you would think that maybe I'm not going to keep losing on every trade. I've got to win on one of these, right? I kind of doubt it. I think they're both going to probably turn into a loss, but that's just the nature of the game. It doesn't matter that the name of cocoa is on the chart or in the database. One of these days, it may be something, maybe a big trend, and it'll pay for all those little losses we've taken. But I've not heard of UK wheat. So send me the link to that, Alp. I've traded Chicago, Kansas City, Minneapolis, and French and South Africa wheat. So I trade 5 wheats, but I have not heard of UK. And then I finally wanted to mention one more thing, which is that I'm sure in a month like November, the trend following on hourly bars had no correlation, very little correlation to what happened to the medium to long term trend followers. So you probably did pretty well this month. What do you think?
Yes. So, that's true. So, usually when there are reversals for long-term trend traders, my strategy, any short-term hourly bar trading strategy would usually get benefit out of it. It's just there is nothing, I would say, complicated about it. It's just the nature of it, because when you're changing your direction much more quicker, obviously, when compared to having a long or short position of 200 days. When you're longer or short based on 200 hourly bars, of course you're gonna just change that position pretty quickly. But there are lots of months that I'm also making a loss as well. It's just my track record is almost identical to any classic trend trader. So there are loss-making months, there are profitable months. It's just I would say there is no perfect system, but I think there could be some benefits in trading all these time frames altogether. And November was definitely a month like that. The short-term systems made money, so I'm a big proponent on saying that if you would be trading hourly bars, it was a positive month, November, and there are a few months like that. Now I'm tracking long-term. I do have a benchmark model for a long-term strategy where I'm trading 200 days long and 150 days short with 70 instruments. So it wouldn't be as complicated as any of whatever you're doing there. Some of you are just trading more than 100 markets, but it just gives me a good flavor to track the long-term trend performance. And definitely November was one of those months where we have diverged in terms of the performance, Jerry. And I'll also send you shortly the UK wheat market bar chart link so that you can see the contracts. Thank you.
I want to say that I have, as I said before, I traded for maybe near 10 years in short-term space, and I want to say that I did a lot of actually trades, a lot of backtest different systems, backtested different systems in this space, and at that moment I did not found something that is better than long-term trading in our trend following trading methodology, and because of certain reasons. Now I have two decisions but I don't implement this right now. I don't do it right now, but I have two decisions in a short-term space, two very different decisions. But and of course, these decisions there are of course with filters, because as I have said before, because if we are doing it's my opinion maybe only, but if we are doing classical trend following, for example, as the turtles did it, without the filters in a short-term space and hour-based strategy, intraday strategy, there are a lot of noise, and this noise we don't see this noise every month, maybe even every year. But when we see this noise, it's a noise like I said before, like from a rocket engine. It's a very big noise. And another problem is transaction costs, and we have a lot of, when we are in a drawdown, we have a lot of trades, and we pay for each of this trade, and it's also a problem. So my opinion that we have, if we are talking about these short trends, we have a lot of them, but I think here we must use some filters, and I have a big research on this topic. So my opinion here.
Yes, Oleg, I would agree. So I'm using as we have discussed before, I'm using a correlation filter. I'm using that correlation filter on the entry only. So I'm looking into the breakout, hourly breakout, let's say 200 hours breakout, and then I'm filtering the portfolio, whether there is any correlated market or not, and taking that opening that trade based on that correlation. I mean, it's otherwise, as you have said, is the trading is so fast while trading hourly bars that the performance degrades significantly if I don't put a correlation filter. And I haven't tried any other filters, to be honest, but the number of filters that you can try is endless to be able to just filter out the noise, as you have said. Now, so I mean, here we discussed. So we have break down this classical trend trading, isn't it? I mean, it has been eye opener for me, to be honest, and I'm grateful that I have learned so much. So, what what we discussed is, the classical trend trading is anything else where you actually trend follow a price time series data, right? A price data, and there is, so you can actually do this on a long term or short term with the volatility data as well, right? And if you use a volatility breakout like a Bollinger bands, then it is still classical. If my understanding is, it is still classical trend trading, so long as you are only trading the volatility bands. There's one array. There's one array and one time series data. So you can either do it with the Donchians, or you can either do it with the Bollinger bands, basically. But you're gonna trend follow one time series data. On the moment that you introduce to the system trend following of two or more arrays, then this is managed, or what we call mismanaged guys are doing. So they are trying to trend follow more than one time series data, and then things get complicated, and they're unable to actually get the benefit of those outliers that are happening for our distributions, because they are in some shape or form cutting those outliers short while they are trying to trend follow more than one array. So this is my understanding, and anyone else can challenge this if I get it wrong, but that's a huge foundation.
I want to say that, first of all, I'm not a fan of correlation filters. I never did this and I don't want to do this, but it's a matter of choice. I'm not a fan of this.
Not in the
But I
long-term
think,
space, but in the short term. Not on the long term.
I understood you. Yes, of course, short-term space is different because I think in a short-term space, there is not such a big problem. Maybe there are some benefits in a short-term space. To make a long story short, there are some benefits, but there are some cons here also. And I said this: it's transaction costs, and this is noise. So if we have a lot of, but in benefits, maybe that we must not be so much afraid of missing a trade here, because if we trade intraday, we have a lot of trades, and a very important moment for all short-term traders that we must understand properly the risk. So I have said before, if we have 1% risk in a long-term space with 2 ATR initial stop loss, it's okay for all of the markets. But if we use, and for example, for one market, okay, it's not a good example. Let's theoretically imagine that we trade without a diversification on one market, SP500. Okay, so we use 1% risk here. But if we use 1% risk with initial stop 0.5 ATR, it's risky. So it's more risky. So we must understand this, that in intraday space, when we can have 10 trades a day theoretically, and sooner or later we will see this. And I know this because I not even backtested this. I traded in this manner for near 10 years. So I know this exactly. So, and the problem is that I have seen that with the proper risk, so in fact, with the same risk, I have seen in this very best case, the same result in a short-term trading like in a long-term trading, but we have transaction costs, we have execution problem. So the result is worse. And the only decision I see, I'm an open-minded person, but I have my core beliefs, my core principles, and so of course all what I do is based on trend following philosophy. And of course I'm think about different things, but here we must do something, and I think it's really based on control. Maybe it's not sound like this, but if we do a short-term trading, we must have this balance between our risk, between it must be the same balance between our risk, between our profit, all these. So the same parameters, and these parameters, they may not look be the same, but in fact must be the same, as I have said before.
Oleg, everything else works the same, man. I mean, there is no difference in terms of what we are doing between the short term or the long term. You just need to manage the additional bits and pieces. Of course, there's certain things are going to change because, as you said, there's an execution risk. So how am I doing the execution risk? I'm using, automation, worker trades. Okay, so I am coding these worker trades so that the code is working 24 hours. 24 hours is non-stop. So I really don't have a lot of execution risk. All right, so this is how it is being handled. So I'm not a big proponent of trading short-term space with discretion or with manual traders. You're gonna be glued to the screen, and that's not good. So that is being taken care of, all right, with the computers. So that's number one. In terms of your costs, you're gonna backtest it, man. You're gonna backtest it. Yeah, okay. So there's a market that I cannot trade. For instance, palladium. I cannot trade palladium. Why? Because my broker is putting there a lot of commissions and costs, and sometimes the more illiquid the market gets, the cost of that market gets higher. And I noticed that I cannot trade palladium because I've backtested it for the last 25 years. I've just made 2 years money out of 25 years. And if they actually reduce the costs and commissions by half, I'm making money and it is tradable, but not like this. So you're gonna backtest each of those markets with our data a good 20 years. All right. If you have access to expensive data sources like CQG provides hourly data. I don't know, to 1980s. So you can even test it even more, but it is possible to backtest it. So costs are not a problem. So you're gonna know by heart scientifically which markets you're gonna trade and which markets you're not going to trade. So that's taken care of, and then the execution is being taken care of by automation. And then what is left? The rest of the system is no different than any other system. So instead of trading, let's say 3 ATRs on the long-term system, you're gonna use 1 ATR, for instance. Okay, that's all. So the model is just going to work as is. And so what I do is I manage the process. I don't really trade, but I manage the code, whether the code base is doing what it's supposed to be doing, whether am I ending up with any bugs. So, I'm just not a not an old style trader per se, but I just need to monitor the code is doing what it's supposed to be doing, and I don't do anything else if it does. Thanks.
Yeah.
I'm sorry.
Let me get in here for a second. So I think that sounds good. And that's what we've heard from Alp and for a while, and that's why I like it a lot. I will say that wanted to get your comment on one thing, Alp, and that is I don't remember the filter thing on the entries. I'm sure you've said it, but that would just be the only thing that I would say that would violate maybe traditional trend following is not to take all the trades, the system trades. So instead of, you're starting with a diversified portfolio and you're trying to winnow down the trades based upon correlation or maybe a strength, I guess, the first one to hit, is it correlated? And then I would say that's kind of a no-no for the way that I trade. And so my question is, have you ever tried, theoretically in the back test at least, trading all the markets and or trading fewer markets? Well, both. So you trade all the markets without that filter. Does it do as well or better, even though you don't have maybe enough capital or you don't want to take all the trades? You can't take the trades for some reason. Or if you just trade a subset of the markets, does that do as well as your correlation filtering on the entries?
Hey Jerry, I tried actually. It's just one of the reasons why I put correlation filter is because the number of trades are too many. So I'm trying to keep the number into a manageable size. So I can reduce the number of markets, so that would work, and I could possibly trade a higher time frame within the hourly bars, maybe 300 bars breakout instead of 200 or 100. So that would work. So there are ways to do that, but I just couldn't find a system that makes that produces better MAR ratio than what I'm trading at the moment. So that's the reason why I do what I do as well. So and it is quite a new area. So I think the more people will start to trade this, we will know better. But it is definitely possible to do what you say, as I mentioned. But there will be some additional hurdles with the number of trades, and the system performance wasn't as good as what I'm running at the moment. Thanks.
And I wanted to say that, of course, if we are trading in the short-term space, I said that I see some benefits here, but I don't trade in the short-term space now, but I see some benefits, and I have even two decisions. And maybe I will do this in the future. Of course, I want to have my main trading activity in a long-term space, and of course, but adding to this, of course, it's doable, it's possible, I think, to have such decision. But I want to say that some. Oh,
Hey, just one comment, guys. So what I have noticed is the thing when I backtest, I see that the parameter set that is psychologically more difficult usually makes more money. Okay, so that's something else that I wanted to share because this is what Jerry Parker usually tells us, and it is still true in the way I'm trading. So if it is psychologically more difficult, you end up, your backtest results and hopefully your actual trading results will be better. So that's that. The second point is, as far as my humble understanding goes, long-term trading will always survive because it is a psychological thing. It's so difficult to be able to trade trades that can actually last years, 1 year or more. So it is a really psychological difficult thing, every day in and day out, just to ride out that noise. So it is very hard on the brain. Okay, as far as my,
oh,
you know, so it is very hard on the brain to trade the long-term system, but the short-term system is very hard on the machine. Okay, if you're trading like I do, because it is fully automated, so you're gonna have a very good code base. So I am writing my own code, for instance. Okay, so I have an advantage there. So you're gonna either hire a developer, and if you're hiring a developer, then that's a big problem because you're gonna be, quite a big size trader, at least trading 7 digits or more to be able to have a developer or 2 or 3 developers who actually can implement your ideas into the code because it's quite an art. There's a huge element of art in what I do. I mean, I don't want to sound too, don't get me wrong, I'm quite a humble guy. It's just to be able, when you write your code, there's an art element as well as a science element because it's like a painting. I think to be able to have the same quality, you're going to have a lot of capital so that you can hire developers to do the work for you. Just I wanted to mention that. But the short-term space is usually hard with on the machines, and it is easier on the mind because it's short-term, so the money is flowing into your account pretty pretty quickly, I would say. And on the long term, obviously, it is very hard on the brain because things are happening on the long term, and it is difficult to write those trends out. Thanks.
I want to say here that, of course, I agree with this, but if you do a proper trading and proper strategy, and no matter here, is it a long-term trading or short-term trading, if I'm talking now about trend following methodology and even elements of, if it's based on an element of momentum, it's every strategy has its period of underperformance. And of course, in a short-term strategy, you do a lot of things. You do every day, maybe, or every week. You do, and you feel like you're doing something, like like working on a building, on construction, on the buildings, and you do something. You build this, of course. But in fact, when you see, and I'm absolutely sure that you will see, yes, you will not see maybe such a big drawdowns from the high. But you will see these drawdowns, you will see the periods of underperformance. You will see some problems, and maybe, as I have said before, not necessary, but execution problems. And at that moment, so you can do, a person, not you, a person can do one mistake and think, oh, it's only one mistake here, it's not very big problem, a lot of trades, a lot of trends, such short-term space, I don't need so much diversification here, etc. But another mistake, third, fourth, five mistakes for maybe a month. And it's critical. It's all critical. And so I think it only, if you do the right thing in almost every field, every aspect maybe of our life, or not every, but almost, it will be the hard thing. So if you do a short-term model or a long-term model, or maybe, I don't know, global macro model, and it looks very smooth, very good, I think it's a sign that caution sign. I think nothing good will not look. Maybe it will be something smoother than in a period of time or so on and so forth. But right things don't look smooth in general, and in these things we see a very good long-term result. And I have said that I'm sure that it's doable in a short-term space. It's doable. It's not something that is not doable. For example, if we are talking about global macro and something like this, I can say that I don't even want to think in this direction. I don't even want to do this. But about crypto, I have to decisions for that and to effective decisions and even more less effective. But it's a matter of choice. And I think it's not something that is very pleasant.
Hi guys, can I ask you a question, Up? What about management of data? Because I think that in the short term, you have many issues with data. Mainly, it's just a thought that I got. I don't know if it's true or not, but it's pretty expensive. It's hard to get data, and from what you said, I guess you need not only the trading data, but also the bid and offer data also. And so besides being a huge amount of data that you will need to be a very good database programmer to manage, what will be the quality of the data? And is it even possible to get good quality data to start doing the backtest? And not only because of the bid-ask spread, which is of huge importance, but also the historical fees that the brokers charge to you in the past. I guess you said going back to the 1980s. Is it even, does that data exist?
So usually your best bet is to use CQG, okay? As far as my humble understanding goes, the best data provider on the intraday space is CQG, and there are more expensive data providers as usual, but still it is reasonably priced. So my databases, I do have a 1 minute database. I think there's more than a billion data points in that database. And then I've got 5 minute database, more than 100 million data points. And I've got a 1 hourly database. So it has taken a lot of time to put those three databases together. That is correct. And it is data cleansing is part of the job that I do. Like I develop my own codes, I clean up my own database as well. But the good thing about the database is once you build it, you don't need to do it again. So once you build those contracts and stitch them as you want to stitch them, so you're gonna have a code to stitch it in a manner. So you're gonna have a future stitching code, not complicated. So I've got one. So you're gonna have that. Then you're gonna have a databases, 1 minute, 5 minutes, 1 hour. You're gonna have that, and then when it comes to the bid offer that you have mentioned, what happens is, so I am using a middle price because it is easy to have a database that uses the middle price, okay? And then I know what my current bid offer spreads are provided by the broker, okay? Let's say I'm gonna trade corn and my bid offer spread is 1 point. So I add that 1 point into my back test as a bid offer cost while calculating my results. So I'm being a little practical around how I deal with the bid offer while going back on a minute by minute basis so many years. So that's how I do the bid offer part of it. It is It is also possible to have a database which has bid and offer data, but I figured using mid prices cuts out a lot of crap out of it, and I can just introduce the bid offer spreads into it as an over the top cost into the system. Thanks.
Thank you. What I used, I don't do that kind of high frequency trading, but what I use is the when you say, okay, how much slippage do I get in functions of the daily bar, right? Like, for example, 100% slippage would be if I'm buying, 100% would be I will be buying at the high of the day. And if I'm selling, I'm selling on the low of the day. If that's 100%, and if it's 0%, that means that I'm buying at the exact price that I want to buy, and then the difference is in between. And then you make a test, a parameter test of how much does the model can stand in terms of that slippage until it becomes unprofitable, and then you guess if that will happen or not.
So that's actually true. So at the moment, my back test, okay, slippage. So I have incorporated all the costs, but not the slippage. Slippage is an implicit cost, not an explicit cost, it's an implicit cost. And so there are two things that are not in my back test. One of them is slippage, the second is mistakes. Okay? So mistakes are also cost to you. And in my mind, I do have a cutoff. Like I'm saying, all right, I'm going to do 20%. If anything else backtests give me, I just chop 20% out of it. So that's usually how I incorporate the slippage and the mistakes. But if you're going to do a lot of mistakes, then you may need to incorporate more than 20% as well. And something else with the slippage is the more trades you have, the more the slippage is, because you actually pay that slippage from winning trades as well as from losing trades. So that's why you need to be smart on how you're designing your short-term system, so that you're not going to overblow it. Because on the back test, it might be very good-looking results, okay? But if you're gonna trade 10,000 trades, God knows what would be the slippage on that. So perhaps 3,000 trades is much better than 10,000 trades if they are giving the same result to you, because the slippage and the mistakes are going to be much less. So you're gonna account for those two. Thanks.
I like what you just said, Alp, because if I have mentioned that when I ask a trader by the way, from all over the world, what your style of trading, and usually maybe most of cases, person says that he is short-term FX trader or short-term stock market trader. Okay. And why? Because it's psychologically, he think that it's psychologically easier. Investors see him a better, it's a more successful person. But as I have said before, you must understand a lot of different elements. If you are in a short-term space, especially, and of course in every space, in every field, you must understand base elements of your trading. You must understand what are you doing. And only this, I'm a short-term Forex trader, and I'm very successful, and I want to have a lot of investors. It's not the case. So I like this conversation about slippage, about risk, that I have said, that it's more risky thing with the same amount of risk in different periods, in different ATR stop losses. So we must understand all these elements, and only after that decide to do the back test. And we will not, like you said, we will not, in a short-term space especially, our back test can be very different thing from our results in fact because of a number of certain reasons.
And Alp, can I ask you another question? Because you said that the more trades you have, there's more a chance of making a mistake. So I was wondering, a very important part of your system must be to design a risk management module that it's really out of the box compared to the rest of your system, right? Because if not, you could start to sum up lots of mistakes, maybe. I don't know, maybe, for example, if your correlation math goes wrong, etc. And since you are on the short-term space, maybe you are using more leverage, or I don't know, but you could have a potentially big mistake, and so you need to have something in your system because you're not trading by hand. So you need something to be very automated and at the same time to be out of the rest of the box. If not, it will make the same mistakes as the box do. I don't know if I'm clear about that.
As I mentioned, so to be able to make money, you need to do something else psychologically difficult anyhow, right? So long-term trade is hard on the brain for obvious reasons. You're riding those trends for so long. Short-term trading is difficult on the machine. So your mistakes are going to come from the machine, okay? Not because it's a bad code, but one of the things that happened this year to me is the bad data. So I managed one of the markets, for instance, like Brazil market, the Brazil index. My broker for some reason decided to just add 1 hour of data after market close. And my entry and exits, my automated system were taking into account that 1 hour bar, and my entries and exits were just actually, it's just wrong. So I learned this year that I need to actually clean the data so that I'm not going to be actually caught up in the bad ticks. And the bad ticks can happen in various ways. So one of them is like this Brazil, the broker is checking this 1 hour data. The second part is if there's a holiday, like because in US holidays, sometimes the Mondays are off. Again, there might be a bad data coming in, a bad tick, 1 hour. Possibly broker is doing a transaction with someone else and giving the data for that 1 hour. So I learned that I need to manage that as well. So another mistake might happen. So what happens on the short-term space? What happens? There's a whipsaw. How are you going to handle that, right? So, for instance, in October, in November, the wheat and the corn prices have been whipsawed. I was on the trends. A news came in that Russia is getting out of this grains deal. Immediately these grains have reversed back. Now, would you enter into a position where the price opens up anywhere else, or would you limit that? Now, this year, for instance, I've decided to put a limit. I'm not going to enter into a short-term trade if the entry is more than half an ATR above my order level. So why it is matters? Because when I do my back tests, I'm putting the open of that specific hourly bar as an approximation. But in real live trading, if the actual price is 3 ATRs above the order level, the broker is giving me quite a stupid price. So, and I'm about to test this, whether it is making sense or not. But that's another area where I will test and implement this simple rule. And this is what Jerry Parker tells systematic discretion. So I'm going to add this systematic discretion rule, and I think this is my only systematic discretion rule, where I'm going to ignore any ATRs above the order level. It is more than 0.5. But for your question, Cordura, you're just going to ensure that the machine is not making mistakes because it is short-term trade when running 1 minute databases, 5 minutes databases, hourly databases to implement your strategy is hard on the code, and there's a data science to it. So you're going to keep an eye on that one as well. I hope this answers your question. Thanks.
Yes, thanks.
I want to bring in Seth, change the subject a bit. I noticed that Seth wasn't happy with some of these tweets about he's tired. He's tired. I get it. He's tired on vol management, correlation target, volatility targeting, and he's tired on fees. Hey, look, this fee thing, it was just a situation. I agree with what everyone said about the fees. If you said it, I agree with it, except my only point was, and this is where it all got started, I think that all of these fees are reasonable, and they all have pros and cons as far as incentive fees and management fees, or combination, or no management fee, no incentive fee. They're all pros and cons. I think it's kind of a funny subject, but I don't agree that either choice or combination is morally, ethically, financially superior when it comes to future performance. And that was the only thing I was thinking about. But it kind of got out of control. And vol management, that's always out of control. But okay, so I wanted to ask what's going on with the trend following on crypto. What is your take on all the crypto, Seth, and trend following crypto? And I think you're still doing it, but what's the future hold for adding crypto to our and trend following crypto in our portfolios?
Hey, thanks, Jerry. It's been a very slow year for crypto trend following. I'm just tracking a long only portfolio because it's still hard to short effectively without using some real obscure and now what seems to be sketchy exchanges. I came into the year with a few long positions that all ended up, hitting the stops. And I've had a few random long entries this year that have fizzled out. I actually just checked before this. I track something like 100 different tokens, and 3 of them right now have active long signals that haven't really done anything. So it's been a slow year. I think the future for crypto is good. I think it's going to be similar. I'm thinking of it kind of like similar to tech stocks in the 2000s, where you had a bunch of hype and a bunch of stuff that ended up not being legitimate, stuff like pets.com and stuff like that. I think there's probably a lot of similarities between all that and crypto, and it's probably just going to take a lot of time for crypto to earn its reputation back. And you're probably going to have to see a lot of regulation come in to clean things up. But risk and hope always seems to spring eternal in markets when you go from the fear cycle back to the greed cycle. And when that happens, trend following is going to allow you to operate in that space without getting yourself in trouble. I had a really great year in 2021 with crypto. And then as things fizzled out in 2022, my stops and my exits kept me from losing too much money. So on balance, crypto has been good for me with the trend following approach, and I'm going to continue to track it and follow it. And I think forward looking professional traders like yourself should start to do the work now to be able to get in the crypto game when things turn around and start going up again.
Oh yeah, I'm preparing. I mean, I still have obviously the Ether and Bitcoin futures on my active trading screen, and obviously I take trend following positions in those markets. And then I've identified quite a few stocks that are known to be crypto stocks, and their charts look a lot like Ether and Bitcoin, unfortunately. So hopefully there will be some more diversification there in that. But yeah, I mean, I'd love to see that as a kind of like another sector: currencies, commodities, stocks, bonds, crypto. Maybe that's asking too much or not the right way to look at it, but it doesn't really matter because I would just add in as many as I felt like would help the portfolio from a diversification point of view. But it is kind of interesting that so many people's lives are caught up in their new career of crypto, and I don't know exactly how that has been impacted by FTX or just the bear market in Ether and Bitcoin. And I think it's kind of strange that, for so many people, you don't have to do hardly any, I'm sure this is obvious to everybody, but you don't have to do any research at all, and it's a no from the very beginning because every now and then we would hear news reports of crypto being stolen by hackers or something, Japan or whatever. And then the SEC says, unprecedented. Well, you can have a Bitcoin ETF as long as the underlying are the futures. So for the first time in history, futures are deemed safer than cash. And so I think those kind of elementary, naive hurdles prove to be ones to pay attention to.
So, I mean, Seth, just a question. Uh, which one you're using? Are you using Binance or are you using what is the this crypto exchange or whatever they are called? So that's the first question. And the second is how many approximately how many markets you're trading in the crypto space? Thank you.
So I use Gemini, which is a somewhat regulated exchange here in the U.S. They're regulated by the New York Fed. So that was kind of the bulk of my cash that was allocated to crypto was in Gemini. And I also used Kraken, which is another exchange that operates here in the U.S. I had a Binance U.S. account for a period of time, but I had some money in there and they actually locked it up. This was even before there was any kind of trouble. This was probably over a year ago now. But I think I transferred some crypto there and then sold it, and then they wouldn't let me use the cash to do something else with for a certain period of time. There's just a lot of strange, just like the stuff you're seeing with FTX. There's not any good regulation in place, and I don't think regulators even understand the space enough yet to be able to regulate it effectively. So there's just a lot of gray area that's probably keeping a lot of institutions out of the space. But to answer your second question, I track it's something like 100 tokens, and I didn't trade all of those, but I kind of have just cobbled together a watch list over time, based on different things. I have a lot of friends in the crypto space, so if someone tells me that there's a token I should be watching, I'll always add it to my watch list. And I have I pull my daily price data from using some Python code that somebody shared with me. Pulls it off of Masari crypto data. So even all the tokens that I'm tracking, I can't necessarily trade through Gemini or Kraken. Some of them you have to trade, on a decentralized exchange. So it's kind of a work in progress on my part, but at this point, I'm kind of doing it more out of just interest and hobby than I am as a serious trading
And
position.
and is there any way to trade these markets from a usual broker, like in US, for instance, TD Ameritrade is a very well-known one, or Interactive Brokers. So is it possible to trade at least 10, 20, or 30 of those hundreds from usual brokers so that actually you face your broker rather than facing Gemini or Binance or Kraken or whatnot? Thanks.
So Interactive Brokers does offer some cash crypto trading now, but it's like through a partner, which is Paxos, which is just a crypto exchange on its own. But kind of the interesting thing is, I don't know how much you guys all keep up with this, but this week there was a lot of news about Silvergate Bank, which has been kind of like the bank that crypto exchanges have been using to, I guess, convert on their side from like cash to crypto and do their cash management. And Silvergate, somebody posted a Twitter thread about it. I think I may have retweeted it that you can find. But anyway, Silvergate basically does business with all the big exchanges in the US: Gemini, Kraken, Paxos, which is the broker that Interactive Brokers uses for their crypto. And they're all intertwined. And at this point, it's kind of scary. You know, FTX was a partner of Silvergate as well. So it's easy to see where you could have some serious, you know, one FTX fails, it affects Silvergate, which then affects Gemini or affects Paxos. And then you have the thing where FTX had this bank that they had bought, and the chief compliance officer of Gemini was on the board of like this bogus bank that FTX was trying to stand up in the United States. So there's still a bunch of mess that needs to get worked out, and I hope it happens because it's kind of a dark cloud over the whole industry at this point, in my opinion.
Yeah, there was a very good podcast I listened to recently. Meb Faber, who had a guy on who talked about being the first person to warn of FTX, but only like a month early, and or something like that. It was not like years earlier, but months earlier, just maybe 1 month early. And then he also went on to talk about Silvergate, and then that's a problem too, according to him. But I recommend listening to that podcast. I was going to tweet a few things off of it because it was pretty interesting. And so this guy's a professional investigator, short seller type. But yeah, I looked at Silvergate. It doesn't look like too much potential downside. That's my first filter, is how much am I going to make if this thing goes to zero, which, things don't go to zero usually, or negative, but it's a good start if you have a really good opportunity. And we've talked about this before. That's one of the downsides, or limiting principles, limiting ideas of using ATRs for sizing.
What is the turtle methodology to size, Jerry? I mean, you mentioned that the way you do it is slightly different than the way we are doing it, right? I think you have touched base this earlier on. Is it possible just to give us a quick refresher if you're doing slightly different to size it?
Well, I use the traditional method to the ATR method. People ask me certain questions about how I do things on direct messages or whatever. And I mean, most all the time I say, well, just, Google the turtle rules. I think they're in the public domain. And I'm pretty sure that whoever wrote, those PDFs with the turtle rules probably got it right, since some of them were in the turtle program. So I think that you can't beat, just using ATR to size your trade in order to calculate the quantity that you want to buy or sell. On the shorts, I would just look to see how many ATRs it has in the possible trade if it goes to zero. And then you can run a back test and it'll sort of show you, number one, shorts are bad. you shouldn't do very many shorts, which, we can't go by that. But then there is kind of a sweet spot that if it's less than a certain amount, it's probably something you can avoid without too much trouble. It's not going to be an outlier. And of course, I came up with this idea 20 or 30 years ago, but I ran it by Richard recently. I'm smiling because, I got to run it by Richard to see if something I've been doing for 30 years, if he approves of it. And then initially, he doesn't always approve of my ideas, but I really have a really great talent of convincing him. I'm laughing again, but I have a way of. It takes me a couple of tries, and then I can usually get Richard to give me a check mark on some of my ideas. But if you look on bar chart, and bar chart I think is a great resource. I just love bar chart. And over the years, I have asked them to write certain studies for me. I didn't ask them to write the breakout study. Obviously, it's probably the oldest study they have, but it is called Turtle Channel Breakout or something, Turtle Channels, which was not my doing. So I appreciate that. That's pretty nice. The Danchin channels, the breakout channels, bar chart calls them Turtle Channel. However, I did ask them to write a formula for what they call adjusted ATR. So you can go and look at that formula, and it's a bit different than the normal ATR. But I back tested a couple of different ways the accuracy of the adjusted ATR versus the normal ATR, and I think the adjusted ATR is a bit more accurate. And it's really trivial, but I'll let you go on that. Go to bar chart, and you can figure out how I changed that formula just a bit. But it's nothing that's going to be earth shattering or change anyone's trading for the better or for the good. It's just a little bit more.
Thanks, Jerry. And you have mentioned the short trades, and you're calculating the how many ATRs this can go down short. But now, after what we've seen, what has happened with the crude oil, that the prices can become negative. Is this the assumption now that all future prices can go to negative? So the downside to short trades is unlimited if prices are going to go negative. Thanks.
Yeah, that's a good question. You bring up a very good point. And this is, I think, well, I did something even worse than that. Confession time. But I reversed it around for interest rates. So if the rate, I would assume the rate could not go negative. So on the interest rates, I would see how much room we had to zero at the entry of a breakout, and then I would divide that by the ATR, and if it was less than a certain number, I would say, okay, we're not going to have an outlier trade in the interest rates because they're not going to go zero. Well, of course, that didn't work out, but they didn't go zero enough. But still, those interest rates, that last leg up or two, 18, 19, 20, those were some pretty decent moves. And you can see my track record. I underperformed dramatically in some of those years and so I don't do that any longer. And then I kind of got religion, and I said, okay, then I'm not going to do the short filter either, but I switched back to using it. And then, so the point you brought up is good because, okay, so here's what has happened to me a couple of times. At the end of 2008 and at the end of 2020. So there were these incredibly great short trades that I got filtered out of. And okay, so in 2008, my performance was less than, it was not that great relative. And it's because I used that filter on a lot of commodity shorts. And the commodity shorts actually did pretty well for the fourth quarter or so, third or fourth quarter of 2008. And so we underperformed. But then in the first part of 2009, all of those trends that I avoided, that everyone else took, they did become not good trades. They were not even outliers, and they may have kind of become a loss. So I was vindicated. I just had to wait a quarter or two. But I'll tell you, and the same thing happened way worse, let's say in 2020, in that period where crude went negative. And because there was a lot of volatility in a lot of markets at that point, my shorts were probably less than most people. And so I had a tremendous underperformance in that quarter as well, the end of 2020, or that third or fourth quarter when the crude went negative. Not just because of crude, it was a lot other markets that I wasn't in. So then I was really beside myself. I'm like, this has just got to stop. It's too much pain. But then from a trend following perspective, maybe if you use volatility management or take profits or these other little gimmicks and just systematized discretion that people use, then you could have booked more of those profits. But those trades did the exact same thing. They never became much of a trade. They had a lot of nice open trade equity. They caused me grief because I wasn't in them, but then they ended up not being great trades either. So I think with all kinds of stuff like this, where, especially with me, looking at the trade stats. So I want this juicy trade. I'm betting. It's like I'm at a blackjack table and I'm betting, and I'm upping my bet and reducing my bet. And so I'm just so totally focused on, is this a good trade to risk taking a small loss? And sometimes they're not. And you just have to sort of suck it up and say, hey, my ideas are great. They're fantastic. The back test is much better by using them. I'm not missing an outlier trade, almost by definition. It's not. That's the whole point. It's not going to be an outlier. But that's what I'm saying. And so, but good ideas don't always perform superior, and bad ideas, your friends who have crappy trading systems, who violate all the rules, they outperform you sometimes, and you just have to suck it up. I'm not saying that. I'm just saying, not as it relates to what I do, but just hypothetically, because I think taking those trades is fine, not taking them is fine. It's sketchy territory. It's thin ice, let's say, but that's my thinking.
Yeah, I said when the price of crude oil in April of 2020 turned negative, you could have switched to the ETF, the USO. What do you think?
Well, switched in the sense of going short. I mean, it probably would have had the same. It probably would have kept me out of that as well, or bought it. I don't know. I mean, I think that another obvious thing about that particular trade, I'm not downplaying, I think it was great to be short. I mean, I wish I was short. The whole time I was watching it, I was like, darn, this is no fun. It's a great story, because that's a fun part of trading, is nailing the big trades, following your system, do what you're supposed to do, and then being extremely rewarded for it. And I don't have that nice story to tell because I wasn't short that crude. But the fact of the matter is that it would have violated the rules of almost every trader, every CTA who has experience. They never would have been in that particular month that went negative because of open interest in volume and the switching over and having to roll that trade forward. So you wouldn't even been in that month necessarily. I mean, there was like little rumors that things can go negative around that time. And so maybe you could say, okay, I could have a little bit in that front month and I'll just take a risk or whatever. But yeah, it would have just been just part of the process to roll that thing days or week before, and you never would have experienced it. But, certainly fun to be short crude at that time and remind yourself that don't ever make claims about these markets. There's a quote this week, Meb has these quotes he posts on Twitter from managers and traders, and he posted my picture up there this week, which was me saying something like, don't ever estimate how far a market can go. So I always think about, sometimes when I've done that, it's been a huge mistake.
Jerry, can I ask you a question about fees? what are you charging? 220?
Well, our firm has a mutual fund, and it charges a fixed fee, and we split that fee with the advisor. And it's much different than our private fund. It doesn't. It only trades 40 or 50 markets, the mutual fund, and then the private fund trades 300 markets and a lot more stocks. So half of those were or close to 40% of those would be stocks. And so we charge 1 in 10 for that fund, the private fund.
Yeah, the EQCHX with AXS investments, the management fee is 1.45%. Is that after your fees or that's the net?
That's the total fee. And so we split that fee. We're the sub-advisor, and we split that fee. Whatever that fee is, I don't remember what it is, 180 maybe? That's what I thought it was, something like that, 1.8. But it's a typical mutual fund fee structure for CTAs. As Andrew mentioned when he was on with Niels, the initial CTA mutual funds were started 10 or 15 years ago. I think our fund is 12 years old. And initially, those funds, a lot of those / all of those were started with a bad concept, which was the idea that you could allocate, CTAs could manage mutual funds without being registered. And then they could also manage them with an incentive fee. And so the way that they did that is they structured these mutual funds to have total return swaps for the trading, and embedded inside of the total return swap was incentive fees and whatever, maybe CTA management fees as well. So 2 and 20. So the fund prospectus would describe the expenses as 150 basis points, but that's just the normal type of fees that mutual funds charge. And then maybe in a footnote somewhere, it would mention that, oh, also on top of that is 2 and 20 for the CTA. And of course, this was egregious and something that should not have been done. And the brokerage firms and wirehouses rebelled against these total return swaps embedded in the mutual fund with minimal disclosure, not the traditional disclosure. And so CTAs, including Chesapeake, started to say, okay, we got to get rid of these things. This was not a good idea. And so we registered as an investment advisor and took away the swap and started sharing, in the management fee as the sub-advisor, sharing the fee with the advisor. So it took a while. And Andrew brought all of this up on his, a lot of it up on his podcast with Niels. And so I'm sure there are some mutual funds out there that still have those swaps and incentive fees in there. You just have to read the prospectus closely.
But it's the same system you are using for that fund, right?
They're very similar systems. There's a little bit of difference in the systems, not much, but for instance, the mutual fund trades about 40 or 50 markets. I trade 300. The mutual fund does not trade single stocks, so it would take positions long and short in stock indices, and I trade single stocks, and I don't go long indices. So you can see a bit of a difference, and so I think it's sometimes the mutual fund performs better, sometimes it performs worse. I think the leverage is lower too. I think its daily volatility is lower than our private fund.
Okay. As far as the long short stocks you are doing, I remember last time Richard mentioned some back tests for Russell 2000. And I think these are kind of questionable because especially during the bear markets, there is no inventory by the brokers for small caps. Have you run into problems with recalls or anything like that of short positions?
No, I mean, I don't trade, I don't short, I don't try to short small stocks. And, oh yeah, I know what I was going to say. So I think that this filtering approach, where you measure the amount of profit, potential profit you can make if a market goes to zero, this has very little impact on like currencies and interest rates, and minimal impact on commodities. So some of these commodities today that are shorts, some of them are coming off high volatility. So those shorts are going to be dubious. You know, if I can't think of one right now, but but it will eliminate some commodity shorts, and so but this sort of filter will eliminate a lot of short stocks. Stocks have this one characteristic that's different from all the other markets. This is from a CTA perspective, where we're sort of assuming from the very beginning that all the markets are the same, and we're going to use the same trend following methods. But even with us, you know, we run into looking at this with such a narrow view of how to view markets. Then even when we look at the stocks, you know, we do notice that the shorts typically have very little potential when you're using this ATR sizing rule. So it eliminates a lot of the shorts, and yeah, but not all of them, but eliminates a lot of them. So most of the time, we don't do a lot of stock shorts.
And can I ask a question, a follow-up question? Now, I'm backtesting. I'm not trading stocks yet, but I'm backtesting it. And what I see, what I observe is when there are large black swan events are happening, like 2020 March, for instance, or this geopolitical event this year, all instruments are at the same time changing course. You know, if you are, you know, long whatever a stock or a commodity, it is reversing. So, you know, I get a sense that it doesn't matter however diversified you are. You know, even though you're trading commodities and stocks and, you know, indices and currencies, they are just reversing, and you're ending up yourself in a drawdown position. Am I getting this part right?
Well, I mean, I'm not sure what your point is. In
It,
hindsight, they all reversed. How confident are you now? I mean, how confident should we be now that, for instance, that in the midst of what looks like dollar reversals or interest rate market reversals or stock reversal, it's just ipso facto, it's all reversed? Well, I don't know. I mean, I don't trade that way. I need for my signals to be hit. I've back tested them, and the evidence is to no, stay short until you start getting your exits in these short positions. So, I mean, in hindsight, it seems very obvious. Oh, it all shifted. So, why don't you shift or go ahead and shift early or use that information? So, but like, I don't know, in the midst of it, like right now, it could be just as obvious. But I think when you're committed to trading systems and trends and rules, then this is one of the unfortunate situations, is that everybody is pretty convinced and you're sitting there still waiting and giving back profit. I mean, maybe I misunderstood your comment.
no, actually, it's exactly like that. Because in 2020 March, my back tests are showing a drawdown before actually making money. And the same thing is happening in 2022 February. at the beginning of this geopolitical event. I'm ending up the largest drawdown of the year, and then I'm getting making money. And it's just, because it just shows that correlation, the diversification is actually not there when you need it most. So why do I need to get into a large drawdown in February 2022 or in March 2022? Because if I'm diversified enough and trading stocks, crypto, all other commodities, whatnot, my worst drawdown shouldn't be happening when actually the world is going through, when the world takes a pear shape. But it is not helping. So that's my point. The fact that even when the world takes the pear shape, I end up with the maximum drawdown. I'm not quite sure what your system will show at the end of the February in 2022 or in March 2020. But this is what is happening with my systems. My maximum drawdown is seen at those moments, and then I start making money. So obviously, even including stocks are not just helping because everything else is changing, as you have said, probably. Thanks.
Yeah, I'm not sure exactly the point you're trying to make. Like, should I trade fewer markets? But I'm really not trying to focus on these. I'm not doing anything to stop these drawdowns. I have done.
So do I.
I've done this
I'm not
back
stopping them.
test. I've done this back test. It's better to trade all the markets. I'm following all these rules. My singular focus now is hunting the outlier, and it may take all of these markets to go against me for a while, and then have this drawdown. But then the loose pants rules keeps me in some of these markets, and then they go right back on trend, and I make a lot of money because of a handful of those markets that were part of the producing that drawdown. But because I held in there, that handful of markets went back on trend, and the 2023 is going to be very great because I didn't focus on the drawdown, and I'm just sort of like an innocent bystander on this drawdown. How did you lose so much money during this period? I was just following my rules individually, 300 markets. And I was not speeding them up or slowing them down or using systematic discretion, in order to prevent this drawdown. So it's really, you're sitting there and you're helpless to do anything, and yet it works out. And yet when you do the back test, it says, yes, exactly. You're helpless. Sit there. You don't know. You can't predict these markets. And your best chance for success is just to follow each one of these 300 markets using these systems and not some sort of drawdown overlay.
Jerry, thanks for doing these spaces because that's valuable information for many people with your experience. Let's consider this hypothesis. At the bottom of the 2020 crash in stocks, I have here the average 120-day correlation of S&P 100 stocks was nearly 90%. Why going short stocks? You can use the index when all the stocks are so correlated. For instance, right now they are about 70% correlated. Isn't it better going long stocks only for trend following? I just want to know your opinion.
I am in favor of definitely using stocks, individual stocks on the long side, and I would not be against shorting indexes, but and Richard gave me approval for this one as well, and I've talked about this on Spaces, and so I think that sort of hybrid approach is perfectly fine by me, and I think it's really rubs some people the wrong way. people who do a lot of sketchy things in their own systems have criticized this idea. Okay, whatever. I'm not going to defend it as, as pure classic trend following, but I'm just saying sin a little. I think I sin a little, and I don't think I have bad ideas running all the way through my system and everything I do, unlike a lot of managed futures CTAs. So I think long the stocks. Oh, and I wanted to say that I'm happy that I don't really pay that much attention to correlation. I mean, obviously, when I set up my portfolio from day one, I set it up, and I'm like, okay, only so many currencies, only so many stocks, only so many commodities, only so many interest rates. So I am from the very beginning saying, what could happen with these correlations in these sectors? They could go to one. Okay, be very careful. From the beginning, not during, not in the midst of, oh my God, I never thought. No, I thought from the very beginning that I needed to be careful with my total risk budget and my total risk budget per sector. So it's not like I'm not paying attention to it. I'm doing the opposite. I'm putting it front and center, first and foremost. From the beginning, I've got that total risk correct and the risk buckets correct. And I'm done. I can now trend follow and take all the trades, which is trend following rule number one, set up your portfolio, your risk management, everything that you do, so you're able to do all the system trades. You can't filter them out. Sorry, I can't filter them out. But I would say that if they're 70% correlated now, that's really not the way I look at it. It's more like, do I have longs and shorts on? And now is a particularly interesting period of time in the stock market where there's a lot of stocks in downtrends. They've been in downtrends for years, and there's a lot of stocks in uptrends, and they're getting more and more into uptrends. And so it's the only level of diversification, meaningful diversification, is coming from the stock sector now. And that's because it's from a trend following perspective, from my perspective, overlaying each stock market with my trend following rules. I actually do have a lot of shorts and a lot of longs. And so, okay, then you can say, okay, but they're 70% correlated. I mean, I don't care. So they go up, I lose on the shorts. The next day they go down, I lose on the longs. I mean, something's going to win out. This market's going to go a lot higher, and I'm going to get blown out of my shorts, or it's going to go a lot lower, and I'm going to get blown out of my longs. And I'm already getting blown out of some shorts now, so I'm not as evenly balanced as I used to be. But I'm just following these rules, and things are correlated, and they're not correlated, and paying attention to that as a variable to your system that I want to avoid because I'm just paying attention to these breakouts.
Just a follow-up question, Jerry. While doing your risk management, let's say you're going to risk 20% across all 300. Do you give this 20% on a portfolio level, or do you allocate that, okay, I'm going to risk 5% to currencies, 5% to stocks, 5% to commodities, 5% to crypto, 5% to interest rates? So do you have these sub-allocations group by group, or you just give 20% to the entire portfolio, and then you can use that 20% out of 2% for stocks or for commodities if the other signals are not going to be there throughout the year? Thanks.
Yeah, I don't really think it matters a great deal how you do it. Rich prefers, if you have a market in your portfolio, each market has the same amount of risk. So each trade is the same size. And that's the way that I think that is probably best. But now you can tilt that, in a way that it's not as random sounding, because you can there's like 50 commodities, and maybe there's 50 currencies or 60 currencies, and then there's 40 5 or 50 interest rate futures and ETFs that you can trade. And so then there's 5,000 stocks. So you've got to figure out, okay, from the very beginning, if I'm going to trade everything the same size, you still have, when you set everything up, this a big ability to trade each sector about the same size if you wanted to. Or I've chosen to trade stocks larger, and it's basically because because I know how to go. I've had some success finding a lot of stocks that are not that correlated, especially when you overlay trend following. So once again, the next time we have a big monstrous sell-off in stocks, people are going to say, well, Jerry got crushed because he trades more stocks than anyone, and they all got crushed today. But then someone else will say, well, wait a second, I remember a Spaces where he kept saying he was short a lot. Not just, so being short and having everything highly correlated, long and short, that's where you want to be. That's not where we are in the currencies and the interest rates. No, we have zero diversification there. And to some degree, we're getting crushed in the interest rates and the stocks at the same time. So we're not even getting diversification from those two sectors. It's like one big sector. And so it sucks. And maybe even the commodities are somewhat related. Crude and the grains and metals, maybe they're somewhat related to this big trade of inflation and dollar. And are we going to see higher rates in recession? Blah blah blah. So it's thankfully we not only start the day with currencies, commodities, stocks, bonds, massive diversification, and we have longs and shorts. Boy, that's huge. And we have the trend following overlay, which can make those positions much different than just the buy and hold.
Jerry, can I say something? A guy from a big Canadian pension fund told me that in previous years, the big issue is that everything boils down to what he called discount rate risk. That the discount rate, everything, I mean, it's just an economic term, and I think you can not do anything about it in terms of modifying your system. But he said when interest rates are so low and the discount rate, which is the rate which is below every calculation, is so low also, all instruments tend to convert into just two instruments, which is risk on or risk off. And then, as you said, there's not much you can do because you won't change your beliefs or your implementation because of that. But he said, when interest rates go up, then you start to see more diversity in everything. Of course, now interest rates are higher, and you're not seeing that much of diversification, as you said, in commodities or in non-US or in non-stocks. But that was an explanation that he told me, and I think that it's something to consider.
I mean, yeah, we're sitting here living through these markets and these fundamentals and these changes and pivots, regime changes. I almost forgot that phrase I like. And we're just, participating in these big sector moves sometimes. And then we're kind of hunting outliers, though, and following our rules, not really knowing what's going to occur. I do think that one of the big, and this is we've back tested these rules. It gives us the robustness and the strength to go forward. And then we're actually implementing them, which is necessary to get that performance. And so much else is happening. What are you wasting your time buying cocoa for? Because it's this big world out here. Get with this. Well, I don't know. I'm wasting my time doing lots of little trades, currencies, commodities, stocks, bonds, longs and shorts. I'm just implementing this like the computer did in the back test. And I'll get swept away maybe positively with some of these big sector moves. But then all of a sudden, I will make hundreds and hundreds of ATR because I traded rapeseed and canola, and not just wheat and corn. So I think there is one of the big confusions. I'm rambling here, but one of the big confusions that pops up every now and then, and I've answered this a million times, and it just continues to be brought up as if I've never, as if the evidence is not obvious, which is that managed futures CTAs don't hunt outliers. They reduce the outlier. As it gets more volatile and more crazy, they reduce that position. And so they only make money with these sector moves. And that's 90-some% of the entire CTA industry. So people like Richard and me or Mulvaney, we're like not even being paid attention to performance-wise because of the AUM differences. And so it's just a whole nother ballgame that when you talk about CTAs and managed futures and Andrew and DBMF, it has very little to do with trend following. Richard and I and Mulvaney are absolutely profiting from these sector moves. And now we're getting punished by these sector moves. But really our reason for existing is to keep trading, and when nothing is happening or when a lot of things are happening, we don't really know, but we may get one of these outliers. 5 or 10% of our trades are going to make all the money. These sort of big sector moves where everyone makes money being short everything, these are really not the primary trend following characteristic, if that makes sense.
Yeah, the Coco long and the feeder cattle short were the losers of the November, Jerry, in my algo. Do you have the same experience? The trend following performance of my algo peaked in June, and since it's about 20% down, of course, it's very profitable. Do you have the same experience with your algos?
I don't think so. My end of October, I was pretty close to my all-time highs. Now look, and I've underperformed this year because I'm so diversified. I had long stocks and I wasn't overloaded in bonds, shorts. And I just, this is something anyone can do. Let me just preface that. This is, one entry, one exit, and a stop loss. There you have it. That's it. Yeah, that's it. That's all you need. Now just trade as many markets as possible and trade them. You can trade them all very, very small. So I have maximum, as much diversification as I can get, and a lot of equities. And so I'm much different. It's hard to replicate what I do because I'm doing all I can to try to benefit from that trend following formula, which is that 5 or 10% of those 300 markets I trade are going to make all the money. Well, what's made all the money this year, though, are these big sector moves. And you didn't need a lot of diversification. In fact, probably the people who have made the most amount of money this year are mostly in bonds, let's say. So they have even less diversification because they probably major in bonds and currencies and don't even do a lot of commodities. So that's, I'm sure, worked out really well. But a CTA who trades trend following by the book, they're hard to replicate because another CTA that trades my system in 300 markets undoubtedly would have different stocks. And a few of those stocks could have made a huge outlier, hundreds of ATRs. And so my performance would not be similar to theirs because I have randomly happen not to have the same stocks and vice versa. So CTA, managed futures CTAs, easily replicable. The smartest people on the planet, CTAs, the biggest firms, Andrew will have a much easier time replicating them, especially as a group, than he will any individual manager who is maximizing the outliers and who has the freedom to trade beyond the 60 or 70 or 100 typical managed futures markets. And you start throwing stocks in there, anybody on the spaces could be the best performing CTA next year just totally randomly based upon the stocks that they chose to trade.
And the leverage, Jerry, because when we compare the performance, sometimes we don't know the leverage.
That's right. I mean, you have leverage thrown in there. You have seemingly trivial random decisions that you made on entry, exit. What was the ATR when your system went short yen, and then what was it on the longer term system that went short yen a week later? It could be a lot of difference. So there's a lot of seemingly trivial decisions that can end up in the short term being very material. But yeah, risk adjusted. I don't trade with a lot of risk either. So I know that some CTAs, managed futures CTAs, I've heard them recently when I've seen some of the amazing returns. I've seen them say recently that I guess they've sold their product as to the clients that, yeah, you should see these amazing returns from us because we know that you're allocating small percentages of your portfolio to us. So we're going to have a lot more volatility to make it worth your while. If you're only going to allocate 5 or 10%, then we're going to trade with a certain amount of leverage that really, when the markets are in our favor, we're going to really crush it. And I'm more like, I want to make 15 or 20% a year, and I don't, and so I set my leverage to try to do that, and it's going to be more boring. And I don't set up my, like the typical managed futures CTA, I would not set up my trading strategy in any way to fit in better with a traditional portfolio. But that's the marketing strategy for the industry, and it has been that way for a while.
Well, the industry started as an absolute returns space and then moved to convexity after a while due to the lost decade. And now you have these replicators, but the DBMF is down 11% from the highs of the high cap. And some people don't like that, especially the retail rushed at the top. So there is some upset over here.
Oh yeah, people don't like drawdowns, and they hold them. They take the CTA drawdowns and multiply it by 4 in their brain versus being more than willing to sit with a 50% plus drawdown in the S&P. Yeah, I think these lessons that have been learned this year of allocating to trend following and allocating to managers who have lots more diversification in stocks, managers that can go short with good money management and risk control. I think those lessons they're going to be unlearned here pretty soon if we keep going higher. Every little bit higher in the Dow and the S&P, those lessons, it's the opposite lesson. You panicked and you went for alternative and went for CTAs, and it was all unnecessary in hindsight. So it's just the way life is. And
Jerry, don't you think there is a sweet spot about the amount of risk that such a product can take? Because I was thinking, and you're correct that many are too volatile, but if you're trying to use them on your portfolio, not as a 100% strategy, but as a complement, something to improve your risk-adjusted returns, maybe the replicators or even the indexes, don't they have a very, very low volatility, and so they end up not achieving what you need them to do in your portfolio? I mean, besides the replication, right? The CTA index that they follow, it's so diversified in managers that it doesn't move that much, especially in times when you need the convexity. Isn't that, and for example, I don't know, for example, your mutual fund, the Chesapeake Strategy one, does move a lot, especially when you need the convexity. Isn't that an issue with all these new products?
Well, I think the issue is, in my opinion, let's just go for the best solution. The issue is they're not going for the best solution. Look, if you have this knowledge on the markets and on trend and how to trade and set up a portfolio, then you don't go back home and say, okay, we're going to be long 60% in equities, maybe indices. We're going to be long some bonds, and we'll allocate 5 or 10% to manage futures, and we'll try to find the managers who use a lot of leverage so that 5 or 10% can really help out. No, you go back and you revamp the whole portfolio, and you say to yourself, this is amazing, because we're never going to get this return and safety from anything else. So we need to, number one, we need to trend follow our equities. We need to trend follow our bonds. We need to be willing to go short both. We need to throw currencies in there. That's a positive sector that makes money using trend following, and it's hugely diversifying. And of course, we need to use commodities because we can't predict when inflation is coming. We can't predict these commodity outliers. We've proven that long-only commodities, they'll drag on performance. So we'll get rid of them eventually because we'll be back into a deflationary, disinflation environment when it comes to the commodities. No, we're revamping the whole portfolio. We're going to not favor any one sector, and we're going to do longs and shorts, and we're going to have our own trend overlay. So that's the logical response. I mean, I get that they can't do it for some reason, and they don't agree with me. Most of them wouldn't even agree that that's the logical response. But you're asking, okay, we've got this dysfunctional portfolio, long-only stocks, long-only bonds. Now, can you help us out? No, I can't help you out. Not if your solution is limited to, I'm going to allocate a bit to you, 5 or 10%, trade it large, and I don't like bumpiness. Can you do something about this 5 or 10%? I'm shaking my head. I mean, you've got to be kidding me. So if you know what to do, if you're allocating to CTAs and you don't understand that they're wonderful, then why are you allocating to them? And if you do understand why they're the best, why don't you take this philosophy back home and create the ultimate optimal portfolio that is trend and it's not 60, 70, 80% equities?
Yeah, because there's this idea that you use them as insurance, right? There's many studies that compare buying puts with trend following, or buying gold or commodities with trend following, in terms of having a secure that you're not falling into an inflation trap. And so at the end, many people, what they do is, okay, let's put this as an insurance policy in our portfolio, but for a part of the portfolio, because as you say, it doesn't, it's not enough to cover the big losses that you can have from a 60-40. And I remember very well that you spoke this week about the S&P being a non-robust strategy, or the buy and hold being a non-robust strategy. But the big funds, the ones that were over 1 billion in 2007, they took the opposite path. They reduced volatility and they reduced divergency in their portfolios. I guess that for them to appeal to the institutional investors.
Oh yeah, it's really I mean, I'm happy that I don't have to do anything that's not optimal for my portfolio. So that is a huge freedom. And so if you're trading a lot of money for other people, then that's great, and then that's your business. You're trading this money, but it's also fun to get out of that and to sort of do the right thing, do the hard thing, do what you know to be right, and not have to adjust. Alp said earlier, it's like a painting. It's like an artist. That's right. You're creating this stuff. You love it. It's yours. You're learning. You're improving. You're not spending most of your time defending your crap. You're learning ways to make your crap better. And then someone comes along and says, you can only do it this way, or you have to do it that way. In order to raise the most amount of money, you've got to you've got to do it this particular way. And you know me, you make a lot of money managing other people's money, and I get it, it's great, but it's so much fun to kind of retire, quote unquote, and then just start, wake up every day and you can do what you know to be correct based upon what your experience has been, and then so much fun. I mean, oh yeah, look, I try to make these provocative and crazy statements sometimes, and hoping that someone's going to say, "What the hell are you talking about?" So, so I did say that about the S&P not being robust, and I was waiting for someone to kind of come back and say, "What the hell are you talking about?"
I was waiting for today to put that up.
That's right. Well, that's funny because I always tell myself that I repeat myself all the time. No one's listening. No one agrees. So why am I doing this? And then I continue to do it. And there's maybe one person out there or two people out there who were like me in 1983, and someone was telling them some good ideas, and I just had a tendency to believe them and then sit on them and research them and confirm them myself. But I never rejected great, crazy ideas. And I think that from a trend following perspective, where we have our whole reason for existing and the whole way we do things is this sample size, and to do this back test and to maximize this sample size and have these loose pants and very few parameters and rules, then we have our one entry, one exit, and a stop loss. And there is, from the S&P 500, there is no one entry, one exit, and a stop loss. And so it's by definition, not something we would accept as being robust way of trading. If we just had a weighted commodity basket and it looked like over time it went up over time, we would deconstruct that. We would never trade that, never rely upon that historical data. That's over the past 100 years, commodities have gone up based upon this index. And no, we deconstruct that index, trade all these markets with one entry, one exit, and a stop loss. And we would say, yes, based upon the back test, all these 60 commodities that we trade, we back tested them all. As a group, they all make money with these systems, and we think that's robust, and we're going to go forward. So there's no way for an index long only all the time to meet our strict criteria with what we're going to do with our money and our clients' money. It's totally unacceptable to trade without a system, without an entry and exit, and without a stop loss, and without paying attention to trends. So we could never accept that S&P. And then Absolute brought up this idea that, which I've heard many times, and I am somewhat agree with. It is the S&P itself does have some trend following component to it, in that the S&P committee adds stocks and takes them away based upon, I guess, their momentum, their strength, their increasing in cap weighting. But one of the latest additions was Tesla a while back, and I remember when Tesla got added, I had probably been long Tesla at the breakout for a year or so. And now at the very top of the market, S&P is going to add Tesla. And that's the trend following. I mean, they're not really following a good systematic approach. They're getting in a year or two after the initial breakout. So if it smells a little bit like trend following, it's not very good. And it's not something you want to do. And it doesn't overcome, it's not something we can allocate to and tell ourselves, well, they're kind of actually trend following these stocks. No, they're not doing it in a robust, good way. So you don't want to do that.
We need to vanquish the idea of the S&P being a trend following system just as much as we need to get rid of the idea that trend following is insurance. It's just a terrible idea to frame it that way, in my opinion.
I agree, and I think to some degree, it's just like when you get out on the road and you're selling your little trend following fund and you're part of managed futures. If somebody comes up with a dumbass idea like that in a meeting and it turns on the clients, or the client came up with it, you're just like, hell yeah. If that's if that garbage is going to get you to invest with me, hell yeah. And that sort of mentality is just over the long run detrimental. And we need to, obviously, we sell what we do is great because it's rules-based, systematic, currencies, commodities, stocks, bonds, long and short, maximum diversification. And people are interested in that and they can't refute that and they've seen it work. And everything else is just a shortcut to that you'll pay for later to get in and grab some money, but you're not building client loyalty and trust and converts. You know, we want to convert people to how, in the same way we got converted when we looked at the evidence, were told the evidence, the small group of us said, yes, that is correct. We love that. And that will turn on a few people just like it turned on us. And that's the way to build something of lasting value.
There is a lot of misinformation from the do-nothing crowd, those passive investors. This is buy and hope. It's not buy and hold. But Jerry, 10,000 basis point, 1,000 basis points annualized return for 30 years is strange and provocative. So you earned that.
I'm sorry, I didn't understand.
Yeah, say your annualized return is about 10% over like 30 years. So that's strange and provocative.
Well, you know, it should be much higher than that and much better than that. And that's a consequence of mistakes and not following, you know, the systems like I advocate. And so that's the lesson for, you know, when I do a simple back test with conservative assumptions, and I mean the most rudimentary conservative and easily implementable breakout systems, going back, you know, since the 80s when I began, I don't see any trader with as good a track record as that. No trader. Now I'm starting with an edge because I know how to put it all together, and but still, there you have it. You know, one of the best, most robust ways of trading. Granted, it has lots of volatility, but I don't see any track record as good as that, as the easiest, simplest strategy. So trend is very powerful, and the human tendency is to not be as disciplined as we should be, and to try to help out trend too much. Trend doesn't need very much help, and the help is in quotation marks because whenever I've tried to help it out too much, I've had bad performance, and it has cost me. So that's a humbling experience that the simplest ideas, no one has as good a track record as the simplest trend following ideas. All right, I'm in Miami today, so it looks very nice here, and I should get out there and enjoy the sun and the beach. And but it's been fun, and thank you everybody for attending, and hopefully we'll get Richard and Absolute back next week, and hope everybody has a good weekend. Take care.